So today, let's talk about stock market after hours and pre-market hours trading, which is also called extended hours trading. Now, is this something that I'm doing? Is this something that you should do? What are some of the disadvantages of trading during extended hours? As you already know, most investors trade during regular market hours. Regular market hours are 9:30 to 4 p.m. Eastern Time. Anything outside of those hours is called extended hours trading. So if you trade before the market opens, it's called pre-market, and after the market closes, it's called after hours trading. Now, your access to trade during extended hours depends on two things: the stock exchange you want to trade on and the brokerage firm you use to trade stocks. For example, in the US, the two biggest stock exchanges are the New York Stock Exchange and the NASDAQ. Both of these allow you to trade pre-market starting at 4 a.m. and after hours all the way up to 8 p.m. But you're still limited to your brokerage account. So for example, let's take Robinhood. Robinhood allows you to trade pre-market, so before the market opens, starting at 9 a.m. and after the market closes all the way up to 6 p.m. So 30 minutes before the market opens and up to 2 hours after the market closes. Keep in mind that most investors will be trading during regular market hours, which are going to be your retail investors like you and myself, institutional investors, big banks, market makers, and the list goes on and on. Pre-market and after hours, there are going to be less investors, so there's going to be less volume and less liquidity in the market. Liquidity meaning how easy is it to buy or sell securities, also called stocks, in the current market. So for example, let's say you bought the Coke stock for $46 in the past and you want to sell it for $48. A highly liquid market is a market where there are many buyers who are willing to buy your Coke shares at $48. So you might say to yourself that trading pre-market or after hours works perfectly with your schedule, because you might work a regular 8 to 5 or 9 to 5. So you say to yourself, you know what? I want to trade either before the market opens or after the market closes because I don't want to be trading when I'm working. Well, stop right there. There are some things that you have to think about. First of all, whenever you're trading outside of regular hours, you will be trading through an ECN system. ECN stands for Electronic Communications Network. This is an electronic system that allows buyers and sellers to come together in order to execute a trade without there being a middleman. Keep in mind that whenever you're trading outside of regular hours, there's going to be less volume in the market because most investors and most traders only trade during regular market hours. There's also going to be less liquidity, like I just mentioned, and the stock prices are going to be a lot more volatile, either going up or going down. With the stock prices being more volatile, you will also notice that there's a larger bid-ask spread. Now, a bid-ask is whenever you look at the price of a share, you will see that there's one quoted price. But if you dig in a little bit deeper, you will see two additional prices, the bid and the ask. Now, the bid price is the price at which sellers are willing to sell their shares at, and the ask is the price at which buyers are willing to buy at, potentially. The difference between the two is called the spread. Now, during regular trading hours, you will have market makers that jump into markets to decrease the bid-ask spread because they're also trying to make money off the shares. During regular trading hours, there are market makers who will jump into a market in order to profit from the bid-ask spread. Market makers provide liquidity to the market and they make a profit by buying low and selling high or doing the reverse, short selling. For example, when it comes to a bid-ask spread, if you go to Yahoo Finance, you can see the additional bid and ask price. So if you look at my example right here, you can see that this particular day in the stock market, the Coke share was selling at 45.64. That's the quoted price. But if you pay attention, you'll see the bid price being at 45.53 and the ask price being at 45.71. Market makers provide much needed liquidity in whichever market that they jump into. But keep in mind that whenever you're trading outside of regular hours, You won't be able to rely on market makers, and you will be in competition with big institutions that have deep pockets. Trading during extended hours will feel like the Wild Wild West. Even though there are some rules set in place, pretty much anything can happen. Now pay attention to this. You are going up against big institutions that have deep pockets, that know what they're doing. They can manipulate the stock market. There is less volume, like I said, and there's a bigger bid-ask spread. That's why you have to think twice before you jump into after hours or pre-market trading. It is highly advised that if you do trade during extended hours, that you only place limit orders. Now, what's a limit order? A limit order is an order you place to execute at a specific price. So, for example, if you want to buy Pepsi at $120, you place a limit order at 120, and this order will only execute once that stock price falls to 120. The most used order by new investors, retail investors, is going to be a market order. A market order is an order you placed and you're pretty much telling the system, give me the shares at the current market price. Executing a market order during regular trading hours is fine if you're a new investor, because you will still be able to get a competitive price that was close to the market price quoted. Now, after hours is a different story. After hours, you could potentially pay a lot more than the quoted price. I do not recommend trading during extended hours. However, if you're the type of investor who is high risk, high reward, you might just want to take a stab at it. Make sure you have a small amount of capital to test and some type of strategy to test out also. Once your strategy works, that's when you want to scale it.